signed a contract for $60,000.
2 weeks later,
they got an offer for $80,000 on that, and they literally sent me a notice to terminate the contract. And I highlighted the specific performance clause and I sent it back to them. I said, we look forward to closing this deal. Like, you guys signed a contract that says that your damages are, I will sue you, I will take you to court, and you will sell this property to me on these specific terms. Okay, so it's powerful. Power of words, the power of clauses, all of these things are extremely important. If you have any questions, drop a comment below. Happy to help out. Hey gang, what's going on? My name's Hayden Crabtree. If you don't know me, I'm the author of this best-selling real estate investment book, Skip to Flip, Secrets to 1% Know About Real Estate Investing. And today, we're gonna be talking about how you can avoid things that will kill any real estate deal last minute in the transaction. And so this is gonna be a really important video, really is prompted by I heard from one of my students inside of my programs that they had an unexpected issue at the closing table. And so this video is gonna apply to all kinds of real estate deals, no matter if you're brand new, no matter if you're experienced, because really I still encounter new problems every time I do a transaction because real estate deals are so unique. So we're gonna try and talk about a lot of different topics today. So grab your notepad, let's dive into the different things that can kill a real estate deal last minute. So the first thing that can kill a real estate deal last minute is bad title work. Okay, so let's talk about what is a title to a property. A title to a property is the document that comes along with the ownership rights of that property, okay? So that is the legal document. The title to a property is the legal document that claims ownership and use rights of a property. Now, title work also has not only who owns the property and their use rights, but it also has a lot of other things on there. One of the most common ones is easements, okay? So an easement is the legal agreement of letting somebody else use your property for something, okay? So an example of an easement could be that you have a public utility, meaning that, you know, the government and all people who use the government's water or sewer or whatever may run through the middle of your property, and you might not know that until you get to the title work, and that could affect your plans for what you're going to do for the project. So let's say you own a piece of land and your plan was to tear down what was there and build a new, you know, apartment complex on there. Well, you might not be able to put a new apartment complex building on top of a public utility easement. And so if you don't get to the title work, if the seller's not aware of that easement because they just never knew, and let's say the easement happened 20 years ago and you didn't know until you got to the title work, well, that could really kill your plans for a real estate deal. That could kill your plans for going and building that apartment complex. And so, you know, bad title work, easements aren't the only things. We also have unknown liens. If there's any sort of mechanics lien, which a mechanics lien is whenever a worker of some sort of trade, whether it's a concrete guy or an electrical guy or whatever, does work on a project and never gets paid, then they have the right to put what's called a mechanics lien on the property, which means that property cannot be bought or sold without knowledge of paying off that mechanics lien. So here's an example of how this could kill a real estate deal. Let's say that somebody inherits a property. Let's say that their parents lived in a house, they died, and they passed it on to their kids. And now you have an agreement with the kids to come forward and to buy that project from them. Well, the kids may not be aware of the mechanics lien on the property. They may say, you know, let's use round numbers. Let's say you're going to buy the house from them for $100,000. Let's say they inherited the property with $70,000 worth of debt on it, okay? So the kids think they're going to sell this project and they're going to get a net positive $30,000 of money walking away at the closing table. Well, if there's a $40,000 mechanics lien and you don't figure that out until right before you buy this, right when the title work gets delivered, and normally the title work on a project is one of the last things to happen, okay? And so if that happens, that means to actually close this property, they'd have to pay off the bank $70,000, and in order to sell this project, they would have to pay that mechanics lien of $40,000 off. Well, guess what? That's $110,000 combined, and you're only buying it from them for $100,000. So that means they would literally have to pay $10,000 to sell this project, and that can really switch how someone feels about selling a project for $100,000 if they're gonna have to pay $10,000 versus receiving $30,000. So that's an example of, you know, an easement, whether it's a public utility or whether it's just another type of easement, could be letting somebody access their property. So let's say, you know, that you have a property on a road and somebody owns a property behind you and they don't actually touch a road. Well, how do they get to that? That's called being landlocked, right? They don't actually have an access. So they could have a cross-access agreement through an easement. And if you don't know that, if you don't know that the person behind the property has the right to travel through your property, property. So let's say it's a house. Let's say you want to buy a house. Well, let's say that you didn't know when you're buying this house that somebody else has the right to use your driveway all the time. That's really going to change the dynamics of a deal and if you want to close that real estate project or not. So one of the things I like to do whenever I'm going through and I'm buying a project is I just like to very upfront, hey, tell me about any sort of easements or other title problems that are defunct on this project. That's what I like to ask the seller or the agent in the deal, okay? So start implementing that, start trying to get ahead of any title problems, and hopefully, there are no title problems. A lot of times, 97% of the time there are no title problems. And then the other 3%, when there is a title problem, you can actually go through and you can remedy that problem. You can figure something out as a way to get around it to where both parties are okay with it, if that makes sense. And you want to get to a place where you're comfortable and you understand all of the different title problems. So again, number one way to kill a real estate deal is unexpected title problems, last minute. One of the next issues is code violations. And so local governments, whether you live in a county or a city or a special jurisdiction, they have what they call our codes. And codes is essentially ordinances, a book of ordinance that says properties must be maintained to this standard. So an example, no fence height may be above 6 feet in a residential setting, or no barbed wire fences may be allowed in a residential setting. Or another one is no industrial building may be 20 feet, maybe within 20 feet of another property line or industrial building. And so it's just kind of this set of codes of, what can be where, what's allowed in certain areas, and that is called the codes. And so let's say, for example, that you're going and you're buying a apartment complex, okay? And so let's say that the apartment complex has 20 units and it's 22 bedroom units. So you have 40 total bedrooms. Well, let's say, for example, that the parking lot there has been expanded by the current owner to allow 40 cars to park in that parking lot. Well, if the current owner did not get the parking lot expansion approved, then what can actually happen is that whenever you buy that property, the government may come to you and say, hey, you're in a code violation, you need to remedy this. And so what that would literally mean is that you, having bought the property, if you weren't aware of the code violation before you bought the project, then what's gonna happen is you're gonna have to go fix it. Doesn't matter if the owner is at fault, doesn't matter if you didn't know about it, the government will literally come to you and say, hey, you're gonna have to fix this. And so one quick example is somebody that I know, a fellow investor, was about to buy an RV park for, I think, $2.3 million. And here's the deal, is that this RV park he was gonna buy was never officially approved as an RV park. Some guy just had 100 acres of land out kind of in the country that he started letting people park RVs on and rent out nightly. And what happened is that the government just never said anything because they just never really cared. But as new industry started to come in, they started to build a battery factory nearby. They started to build an Amazon plant nearby. And as this small town started to say, well, look at us, our property is becoming more valuable. We're getting a lot of new business in the area. We're gonna start to care about our codes. And so they literally said, as soon as somebody buys this property, this RV park, we're gonna slap them with all these code violations and we're gonna make them get rid of all RVs. So if the guy I had known had bought the RV park for $2+ million, he would have essentially, the day after he bought it, all of that land value, all of the value he had paid for the income that RV park was producing would have instantly disappeared because the government would have said no more. And so what this essentially means for you guys is if you're doing a project, you just want to go ask, you want to go down to the city, you want to call the city or county or whatever jurisdiction you're in and ask about any outstanding code violations on the property that you're purchasing. Hopefully, again, there's none, but you just always want to be sure and ask if there are any outstanding that you can get ahead and in front of that curve. Okay, so code violations can be a deal killer if you figure out about them last minute, and hopefully you figure out about them before it's a problem, before you buy the property and then have to fix it afterwards, okay? You can get ahead of a lot of these problems. It's your job as a real estate investor to figure out any issues with the property before your due diligence time period ends, okay? So in real estate contracts, we have a couple of different periods. From the day you sign the contract, you wanna have as much time as possible to perform due diligence, which means that you can get out of this deal pretty much with no penalty. Now, if you go past your due diligence period, then your earnest money is gonna go hard. And what that means is that money, that deposit you put down for this contract is at risk and it really is no longer your property, okay? If you don't close after that due diligence time period, ends, then that money you put, that deposit, goes back to the seller. It's no longer your money. So it's your job to make sure that you, one, negotiate a due diligence period where your earnest money deposit is safe, and then to get all of these different things we're talking about done and figured out before that due diligence time period ends, okay? That's a caveat to all of this, okay? So if you don't get it, then these are the things that can kill it last minute. Hopefully you can figure out about these things beforehand, okay? Next up is bad physical inspection. And so what that means is that if we're buying a house or a commercial property, whatever, we want to have somebody who's familiar with construction, familiar with how buildings work, go in and do an inspection on the property, right? We just want to get a physical inspection, and we want to understand, hey, how are all the components of the building functioning? Is the roof okay? Is the foundation okay? How's the electrical panels? How's the plumbing in this? How's the HVAC? Are there any problems that we need to know about that's going to cost us money that we need to fix? And so if you don't get your physical inspection until the last minute, and then at the last minute you figure out, wow, the foundation's bad, I had no idea. The plumbing all needs to be replaced, I had no idea. And that can really kill the financials of a deal, because that may say, man, I was buying this house for $100,000, now I need to put $30,000 of work into it. This doesn't make any more sense. And by the way, your property is not going to be more valuable because you put a roof on it, because you replaced the plumbing on it. Investment properties are based off of income, and you can't charge more rent just for working plumbing, for a working roof. That is just a set. You have to have that, right? So in some areas you can spend money and it's an investment and you can get more than the amount of money you spent back. In other areas, like the fundamentals of a building, those have to be working, and you're not going to make your money back on those, okay? And so again, bad physical inspections, as soon as you get a property under contract, go ahead and find somebody to do a physical inspection on a property. Don't wait until your due diligence is over. Next up, and this might be the most common one, is a bad appraisal. And so whenever we're going and we're buying a property, again, let's say we're buying a house for $100,000. Let's say we need a bank loan on that. We're going to get an 80% bank loan. So the bank is going to give us $80,000 and we're going to put down $20,000. We, in order to make the bank feel comfortable, in order to avoid mortgage fraud, in order to make a bunch of the desk sitters happy, we have to get appraisals, okay? So even if you're confident that a property is worth $100,000, that you're getting a good deal at $100,000, doesn't matter. You still have to pay for an appraisal, which is a third-party report. You literally pay somebody who's an appraiser to come out and to do a report on the property and say, here's how much they think the property is worth. Now, they're not buying the property. They have no financial incentive to say one way or another how good the property is or what it's worth. They are just filing a report. And so if you're wanting to buy a house for $100,000, you're gonna get an 80% loan. Here's where things can go bad is if your appraisal doesn't come in until the last minute, and let's say on this $100,000 house, the appraisal comes in at $80,000 instead of $100,000, the bank is only gonna lend 80% of the appraised value or the purchase price, whichever is lower. I'll say that again. They're gonna lend on 80% of the appraised value or the purchase price, whichever is lower. And so if the appraisal comes in at $80,000, the bank is only gonna lend on 80% of $80,000. They're not going to lend on 80% of $100,000, which is what you're buying it for. And so what that means in real terms is that the loan amount you're going to get is less, and your down payment is going to have to increase. Now, the bad side of that is if the appraisal comes in at $200,000, the bank is not going to give you more than 80% of the $100,000 purchase price. And so it's always good to have high appraisals. It's not really going to help you out in any way, shape, or form other than just feeling assured that you're getting a good deal on the property. But when an appraisal comes back bad, it comes back negative, it comes back lower than your purchase price, what that means to you instantly is I'm going to have to put more money into this deal, or I'm gonna have to go back and try and convince the appraisal. And so one thing that I always do before I actually go through and get an appraisal done, one is I always like to be able to contact the appraiser. I like to tell my banker, hey, I'd like to get in touch with the appraiser. I have some information that I think will be helpful for them whenever they're appraising this deal. And so that gets my foot in the door. I can talk to the appraiser. And now what I do for the appraiser is I send them a bunch of comps that I've looked at that show my property in a positive light. And I also share my pro formas if it's an investment deal, if it's a commercial deal, if it's a cap rate deal. I always like to provide evidence that I am buying this property for less than I think it's worth, which I always want to buy property for less than it's worth. I always want to buy with instant equity. And so normally I can prove that out. Now, if you want to share your pro formas, the easiest way to do that is through MyPropertyStats. This software company I created to help real estate investors underwrite and analyze deals, store all their notes, and store all of their due diligence documents. So as you're going through your transactions, if you want to share files with appraisers, if you want to share files with bankers, you can do it all instantly at MyPropertyStats. The cool thing, I think it's the world's best deal analyzer, and it's only $99 a year. So check out MyPropertyStats. I'll post the link in the bio as well. And always know, get your appraisal done as soon as possible. Try and talk to the appraiser and try and send them positive information so you can assure yourself that you'll get a good appraisal and not have to worry about this one. The next way that a deal can be killed last minute is closing cost creep. And so this might be something that you are not expecting, especially if this is your first investment property. Closing cost creep is whenever your closing costs start to add up in a really big way. So let's use an example. Let's say on this $100,000 house, I say, okay, well, there's a $100,000 house. I have $20,000 for the down payment. That's how much I need. But really, all the cash I have on me is 30 grand. Let's say that's the situation you're in. And let's say, I really want to keep some money just in my personal bank account. I don't want to spend all of my money on my investment, which I think is a smart strategy. But let's say that, okay, I'm going to do $20,000, but then the appraisal costs $1,000. And then let's say, that you had to get an environmental report on this project, and that's another $1,000. And then let's say that the physical inspection was $700. Okay, and then let's say that the title work that you weren't expecting on this project, and the property tax prorations, let's say that adds up to another $2,000. And all of a sudden, you thought you were going to be writing a $20,000 check to close this property, and really you're going to be writing a $26,000, $27,000 check to buy this property, to invest in this property. And so you need to be aware of how much your closing costs are going to be before you go into the deal. These are predictable ways to do that. And so one of my favorite ways that you can do this is there's a website called Smart Asset, and you can go on there and there's a closing cost calculator that you guys can use absolutely free. And you just want to make sure that whenever you're analyzing your deals, you understand that part of your down payment is not just the 20% of the purchase price, but it's also going to be the closing costs that you're going to have to pay into this property in order to close the deal. And so if you're not aware of that and you get to the closing table and you go, man, I got to write a $26,000 check. I was only expecting $20,000. That can really impact the numbers of the deal. That can impact how you feel about investing in this deal and the comfort level of all this. And another thing is you want to have operating capital, right? You want to have money in that businesses, that rental property, that investment property, commercial property, whatever kind of property you're buying. You want to have money in the checking account as you wait for rents to come in, rents to go out. I talk all about this. There's a whole chapter on it in Skip the Flip 2. If you guys hadn't bought that book, I'll post the link to the Amazon down below. It's my favorite book. People who have read it said it's better than my first book. Again, you can get that one for free. If you've already read it, pick up my second book. I'm getting raving reviews. It's better than the first, okay? So the next thing that can kill a deal is a mail away closing. Listen, it's 2022. We're living in the modern world. You don't have to be located where the property is. Let's say I'm buying a property in Florida. The last deal I closed in Florida, I signed the documents here in Georgia. I live in Atlanta. I did not have to fly to Florida, drive to Florida just to sign the documents. We can do what's called a mail away closing, which is where they send me all the documents via email. I print them all off. I get them all signed. And then they need originals. Okay, it's called wet ink originals, which is the actual piece of paper that I signed, the buyer of the property signed, is what they need. And a lot of times they can't close a deal until the wet ink signatures come in. And so if you've sent anything in the mail, it can be kind of crazy. Things in the mail have taken a long time. So you always want to make sure, if you ever are doing a mail away closing, I don't take a risk. I FedEx it. I choose the overnight option. I get a tracking number. I make sure I know where those documents are. I don't just put things in the mail. If you are doing that, that can kill a deal last minute, as your documents are supposed to get there. And let's say the contract time period ends on the 20th. Let's say that you haven't had the best relationship with the seller, or let's say, as we're going to get into in a second, they have a higher offer than you and looking for any reason to kick you out. If those documents don't show up by the date they need to show up, then you're out. That contract is canceled, and that can kill your deal. So if you are doing a mail away closing, make sure you sign a couple days early. Make sure you get a tracking number, send it via UPS or FedEx, and make sure it gets there not only on time but early. So as we just mentioned, the next thing that can kill a deal is a higher offer, okay? So a higher offer meaning I want to buy a house for $100,000. I feel like I'm getting a good deal on it. And let's say after I put this deal under contract, somebody else has contacted the owner and they've told the owner, hey, I'll give you $150,000 for that deal. Now the owner may be saying, holy cow, an extra $50,000. I want to cancel this contract I've got with Hayden and I want to go sign this contract that I've got with Bob or whoever the person who offered $150,000 is. And so they are in a legally binding contract with me. And so the way I always protect myself, and I want you to always protect yourself from this happening, is to have a clause in there called the specific performance clause, which essentially states that if you don't uphold your end of the contract, my remedy, it's called a remedy, essentially my repercussions, how I can make sure you do your job, is I can make sure to hold you to a specific performance, which means your specific performance is you sell this property to me on these prices. And if you don't do that, then I'm going to sue you and I'm going to take you to court, and a judge is going to make you sell me that property at that specific price. If you don't have a remedy, and especially if you don't have a specific performance remedy in your contracts, what that's going to do is it's going to allow the seller to cancel your contract and not have any sort of repercussions. And so some contracts I've literally been sent have no repercussions if the seller breaks the contract. Guys, you're putting in earnest money, you're putting in time, you're putting in money for inspections and reports and appraisals and everything else, and you have opportunity costs. Do yourself a favor, never sign a contract without a remedy of a specific performance inside of that contract. If the seller cancels, you don't want your earnest money back. You've spent time and energy and money. You want to buy that property, okay? So if you don't have that in there and they get a backup offer and there's no repercussions, there's no negative penalty for them if they don't, guess what? Your contract's getting canceled and they're going with that other people and they're gonna make that other $50,000. And so that's one thing that can kill a deal, is if another offer comes in and they don't have any sort of damages, they don't have any sort of penalty if they cancel your contract, and that's gonna happen. I had that happen to me in the early days. I was buying a storage facility. I think it was a small one close to a bigger one I owned. Signed a contract for $60,000. 2 weeks later, I made sure I had the specific performance in there. 2 weeks later, they got an offer for $80,000 on that, and they literally sent me a notice to terminate the contract. And I highlighted the specific performance clause and I sent it back to them. I said, we look forward to closing this deal. Like, you guys signed a contract that says that your damages are, I will sue you, I will take you to court, and you will sell this property to me on these specific terms. Okay, so it's powerful. You know, the power of words, the power of clauses, all of these things are extremely important. If you have any questions, drop a comment below. Happy to help out, because I don't want you guys to get caught in a situation to where you wish you had that and the higher offer came in and you got screwed, you lost a bunch of money, okay? And so finally, the last thing that can kill a deal last minute is simply called deal fatigue. What is deal fatigue? It's a real thing. Whenever you've been working on a big project or even a small project for a long amount of time, you just get tired of dealing with the same issues over and over again. You get tired of following up with the same people over and over again. And so deal fatigue is where you literally just say, forget about it, I'm done with this, it's not worth the headaches anymore. Guys, don't fall into this. If you at one point thought a deal was good, you should never cancel a contract or not do a deal simply because it's been a challenge, okay? You need to endure, you need to overcome challenges. Now, in a situation where you can do this is if you find out information about, well, it's gonna cost this much to fix this, the numbers no longer work, that's fine. That's not deal fatigue. That's a change of information. Deal fatigue is when you literally are just like tired of dealing with a set of problems that you have known about. And so don't fall into deal fatigue. Don't let sellers fall into deal fatigue. Don't let your lenders or attorneys or anybody else fall into deal fatigue. One of the ways is just staying positive and always bringing energy to the table and trying to avoid deal fatigue. The best thing to do is just try and close deals quickly to not have deal fatigue. But I worked on a 7-month project where, you know, at the end of the day, you know, on closing day when I should have been happy about getting paid, I was just like, thank gosh it's done and I don't have to worry about these issues anymore. Okay, so don't fall into that trap. Don't let deal fatigue kill any of your deals. Just try and stay positive. And if you've noticed that you're getting into a longer, stretched out kind of deal, just think long and hard before you progress about, you know, how am I going to avoid deal fatigue? How am I gonna make sure that I can still stay positive and accomplish my mission here? And so I don't know how many ways that was that you can kill a deal. That's a lot of ways last minute to kill a deal, but here's the thing, all of these ways are avoidable. If you have any questions about any of that, drop me a comment below, share this video with somebody, and if you got 1 ounce of value out of this, I wanna ask you to subscribe to the channel, and I wanna ask you to share the video with one friend you think could also use this to help me grow my channel. I appreciate you guys so much. Have a great day. Be great.